Welcome back to another session. Once again, this is Benjamin Nusz, MREA instructor and Mid-State Technical College instructor. And here in this lecture, we'll be talking about system cost estimation and then the financial analysis of these types of systems. We'll start off by looking at what the associated costs are. And we don't have quite as good of tracking data as they do in the PV industry. There's a website called OpenPV that NREL puts out that tracks the system costs and provides all this great data. And we don't have the same sort of information provided on solar thermal systems, but we will look at the available data that we do have. And while it is a bit dated, it is still fairly consistent with what we see in the industry. And then we'll look at the financial analysis of this. And ultimately, we get to the point of looking at payback and what these systems will actually perform over a long time. Now, this is data that we have from 2009 that we tracked actually in Wisconsin. And we look at some of the trends that we have, and they looked at the numbers and the installations for flat plate collectors and evacuated tube collectors, and then based on the overall square footage, and then what type of system they were there to do. These are just ones that are for domestic hot water. These are ones that are for also with space heating. What we saw is at that point, there were a lot more flat plate collectors being installed than evacuated tube collectors, and this still holds fairly true. The other thing that we saw is then the median price. And one of the things that you see is that for small systems, the median price is fairly high, but then as soon as you start to get to larger systems, the median price goes down per square footage. And this obviously makes sense. I always tell people that the most expensive collector you put up is the very first one that you put up. Because in order to put up one collector, you have to, well, first have a site assessment, then you have to have a design put together, you have to get your permits, then you have to place your order, you have to pay for shipping costs, and then you have to get all those materials to the site, and then you have to set up your ladder, you have to find out where all your trusses or rafters are, do all your layout, mount your first hardware, and it's somewhere between 8 to 20 hours of labor just to mount that first collector. Then to mount one more, well, it only takes about another 15 minutes. And so the added additional cost for collectors 2 through whatever is a much smaller increment because it's just going to be cost of the equipment and much significantly less labor. So we see that being the case. A lot of these small evacuated tube collectors are a single collector, like one 30 tube collector that has a much higher cost per square foot. So that's why I always encourage people to go a little bit bigger on the collector array size, because you'll find that increased production you get quickly offsets any additional cost that's associated with it. So mainly we want to look at not really these small systems because they're kind of outliers, but looking at these other ones. When we look at the larger range, well, for residentially, it's somewhere around $125 to $225 per square foot, but we don't always see that that's the case. My general rule is that it's about $125 a square foot, meaning that a system will cost you around $8,000 to $10,000 for kind of a standard residential system. Now, this is obviously the cost before any incentives that are out there. Sometimes we break this off into some of those components. People are always saying, well, how much is a collector? Well, you know, a collector, the price of the collector itself will range anywhere from $800 to $1,600 just for the collector. So the installed cost is somewhere around $40 to $50 per square foot. Solar storage, depending on the type you have, may have an installed cost of $15 to $30 a gallon, and then you've got these other things like the components and labor piping that is out there. At this level, we really just look at that general price. Okay, it's going to cost about $8,000 to $10,000. To get a much more comprehensive value, then you need to get a bid from a contractor or put it together based on all of the individual components. Most package systems, if you're looking to buy like a pre-packaged system, it's got the collectors, it's got everything that you need, and it comes in the box. Those are somewhere between about $4,000 to $6,000 just for the equipment. So if you're a do-it-yourselfer type of person that's looking to do that, then that's about the range for all the associated components. Of course, there are many factors in what that system cost is going to be. Obviously, how big it is. We saw larger systems, greater economies of scale, lower costs per square foot as well, but then a larger overall cost. The system type makes a difference. We see that drainback systems cost slightly larger than pressurized antifreeze systems. We've seen evacuated tube systems that cost slightly larger than pressurized evacuated tubes slightly larger than flat plate systems. They're generally all within a range, so it depends more on the manufacturer than the collector type. The installation method, are we going on a roof, or are we going on the ground, and how accessible is that mounting location? Do we have to do structural reinforcements or curbs? Do we need to have a lift and rent a lot of equipment just to even get the collectors up there? Those things obviously matter. How we will be integrating into it, if we're just doing a domestic hot water system, then the integration is very simple. We're putting a tank next to the other tank and preheating it. If we're tying into a boiler and doing some space heating, well, sometimes then the integration can get complicated, especially if we have to make modifications to the original system. Codes in municipalities really do make a difference. This is what we call soft costs associated with the installations. In some cases, the soft costs are very small. It's just basically the cost of the permit and the little bit of the time that it takes to go to the permitting to the permitting agency and to the inspector's house. In a lot of rural areas, it's very easy to get a permit, and in larger cities, it can be very complicated. And so we've seen in our own state, areas in Madison and Milwaukee working to try to figure out ways to streamline this permitting process, because a lot of time and a lot of delays can be associated with this. So you really have to know what your area is like and who the authority having jurisdiction is to determine how long this is really going to take. You may not even know which permit they're going to require you to take. Generally, because we're tying into the potable water system, we need to get a plumbing permit. And also because we are involved with some part of the structure, we generally need a structural or a general construction building style permit. Many cases I've had to pull 2 permits, and in some cases I've had to pull 3 permits because we're tying into the heating system as well. I've gone into some places and they just had me pull a heating permit or just had me pull a general construction permit. My recommendation here is to go in and ask them which permit you're going to be required. They are the authorities having jurisdiction, or the AHJ, and so go ahead and ask them. Tell them what you want to do, and then see what will be required of you in terms of documentation, because everyone's going to be a little bit different. Of course, the pipe runs and how you're connecting the collector to the solar tank may have an associated cost as well. Trenched and buried and external pipe runs cost significantly more in terms of installation labor and materials than do internal pipe runs. So my strategy is get inside, get into that attic as soon as possible, and then use the attic to move horizontally or laterally and get inside, instead of trying to run along the outside. If we run along the outside, then you've got jacketing and you've got painting and you've got different attachments and all these things that can make it more difficult and increase the cost. And then we have incentives that are going to be available, and this depends on where you live, what state you're in, what country you're in, and do you have any utility-based incentives. In Wisconsin, our incentives are always changing. They change from month to month and year to year, and all states are generally the same. Your best place to find out about this is the Desire website, and this is the database for state incentives for renewable energy, USA.org, and you can see the link right here, and I have some of the screenshots and data that's pulled from these, because they do a great job of publishing what incentives are going to be available. It's a database. They stay fairly current, and so normally sometimes by the week or by the month updates are pushed out. So that's where you want to go. And what they will do is they will list both federally and by state which incentives are out there. They will have the actual code that's included there as well, in addition to a plain English description of the policy or incentive that is going to be relevant. They'll also include links to the actual code, and then they'll have a contact information, normally for a real human, that you can call if you have questions. So anything to do with incentives and you trying to figure out the best place to start is this Desire website. Now, this, of course, is dynamic, and so the chart that I have here that is for the country, but this is showing state programs or utility programs, and this is from December 2008. And there's no real reason to put a current one up here because next month is going to change again. So the best place is to go per your own state, and then you can find out what those incentives are. One of the things we do see is that it is non-uniform across the entire country. States have really taken the lead in driving their own incentive programs, and that's why California is the leader. But it's also why New Jersey is number 2. It's not generally who we suspect to be number 2 in terms of solar deployment, but because of some real progressive policies, they've positioned themselves to be so. So this is showing some of the rebate programs for states. In rural communities, you will find some USDA grants that are out there as well, called REAP grants that are competitive. Generally, to be in a rural area, it has to be with 50,000 residents or fewer. So those are going to be available on the federal level, in addition to the federal tax credit. So if you have any sort of tax burden, then this is going to be your number one go-to incentive. And it's 30%, and so it's quite substantial. 30% of the net installed cost. And that's what we say net, because you first have to reduce any other state or local incentives that you have. So let's say we have a $10,000 system, and then you have, let's say, a $2,500 or like a 25% state incentive that's out there. So that then reduces the price to about $7,500. The 30% comes off of the $7,500 after any other incentives have already been taken off. So that would reduce it down even further. This is not a tax deduction, it's an actual tax credit. So dollar for dollar, it's worth all 30% of it. So 30% on $10,000 is $3,000, and it's worth every penny. This can be rolled over to consecutive years. This is what I had to do because I put in such a large solar water heating system that it exceeded what my tax burden was, but then I got to use it again this year, and we'll be able to use it again next year. The tax credit expires in 2016, so if you're looking to take advantage of this, that's when it ends. Tough to say whether it will be extended. This was initially introduced in 2005 for a 2-year period. Then we got a 1-year extension, and then we got an extension all the way till 2016. And kind of short-term extensions on a 1 to 2 year basis are very difficult for the industry to adapt to, in particular big wind projects, because they take so long to develop. So any big projects really need some stability out into the future. Ultimately, you will want to talk to your tax advisor or tax accountant about your tax liability and see how this will affect your own finances. There are also a bunch of other things that aren't direct payment that yield some form of a benefit. So in addition to, cashback rewards or tax exemptions, there are also some tax exemptions, for instance, on property taxes. And most states have something along these lines, that when you put up a solar water heating system, it will increase your property value. And ideally, you wouldn't have to pay property taxes on that each concurrent year. So many states have property tax exemptions that it doesn't count towards your property taxes. There are many states with sales tax incentives as well. So you're not paying any sales tax within that state, which on a $20,000 system that can be pretty substantial. And then there are also some statutes about siting and placement. Every state's going to be different, so the Desire website is really going to be the place to go. I can tell you that in Wisconsin, we have some state statutes that prevent municipalities from prohibiting people to put up solar. So states are required to allow people to install solar, and so that's a good one that we have here in Wisconsin. So that's about where our costs are. Remember, it's around $125 per square foot, depends on any number of factors. The next question, of course, is about financial analysis and what we do with that associated cost. How do we interpret this number? Because obviously there's a lot of sticker shock when we say, okay, it's going to be $10,000 just to heat your water. Okay, yes, there's some incentives, but that's still a substantial chunk of change. So what we're going to be looking at here is how to interpret this information and how to analyze it. Ultimately, I hope to convince you that solar water heating systems are actually free, that they don't have an associated costs if you analyze them in the right way. Well, the first way we're going to analyze it is in terms of equity. Now, equity is something that you own. It's the value of a ownership in property or a particular object. And when you add a solar water heating system to your home value will go up. Well, it depends on how we assess that value. We had just mentioned that your property taxes, ideally, if you live in a state that has a property tax exemption, don't go up. Well, how do they determine your property taxes? And that's typically done based on the assessed value. The assessed value is done by someone that comes by with a clipboard, and they look at the value of your land and then the improvements on that land, and that's how they determine your property tax base and what they can tax it on. Now, ideally, it shouldn't increase that one because you have a property tax exemption. The other two ones that we have are the fair market value. And fair market value can only be determined once the property is actually sold. So you're not sure what sort of value it has increased until you actually sell your home. However, you can then look at comparable properties that have sold recently to determine what your fair market value is. But therein lies the challenge. I recently was selling a home, this was a couple years ago, that had a solar water heating system on it. And when they were trying to do an appraisal of it, they said, well, we don't have any comps. We don't have any things that are in your neighborhood that are of a similar square footage and number of bedrooms that have solar on them. Because I had a solar water heating system and a solar air heating system, and they said, well, we really don't know how to appraise this particular portion of it. So they didn't include it in there. They said, well, we don't have a comp, so we can't do that. And so that's a difficult one to pin down. The appraised value is similarly going to be based on comparable sales that are going to be in your area, and then also based on some of the amenities you have. So the most important one, of course, is your fair market value. Does it actually increase your fair market value? And as we know about home sales and real estate, is that location is everything. An identical property in San Francisco is a much higher value than an identical property that's here in central Wisconsin. Similarly, the value of a solar system in California will probably sell for more than or be valued more than the same sort of system here in central Wisconsin. So location is key, and knowing your markets is key. Now, I mentioned I recently sold a property that had solar on it, and it was my first house. And in that particular case, I'm not certain that I got the full value of that solar water heating system back. However, I know that it in some ways helped me actually sell the house. I was in an oversaturated market. In my particular block, there was 6 homes for sale at the time, and my house sold first. And so it may be the sort of thing that got me some showings, that got my house to stand out, that got it off the market before some of these other ones. So sometimes that's the sort of thing that is hard to value as well. Nonetheless, we know that it is something that can increase the value, and we are starting to get some data on this, but so far the data has only really came back in California markets. I think it was Sandia National Labs recently put out a paper about 2 years ago about not dealing with solar water heating systems, but with solar electric systems. And they found that in California, the additional value that people got when they actually sold their homes, because there were so many homes that were sold with solar on it, was roughly equivalent to what those people initially paid for it. In other words, people were getting back almost all of what they paid for the system when they sold their home, in addition to getting free energy over the entire life of that system. So in a mature market, then they are fully valued. In a developing market, well, it may be the sort of thing that helps you stand out. When we do look at the payback, we're going to start using that term, we have to look at this in a little bit of a broader picture. We refer to this as life cycle costing, not just looking at that initial cost, that initial $10,000 or $8,000 system, but what is the cost of the entire life? So it includes not just the cost of the equipment, but also planning, design, and permitting, and includes maintenance costs, and really should include removal and decommissioning as well. So it's all of these things wrapped together over the entire life of it. So when we look at programs like RetScreen or like the System Advisor model that will do some of this financial analysis for us, well, they do take into account all of those. And what they will put out is a term called levelized cost of energy. You take in the total costs that are associated with the installation and maintenance and decommissioning, and then you look at the total amount of energy that it produces, and then you divide the total amount of energy by the total costs that are associated with it, and then you get the total cost divided by the amount of energy, and you get things like dollars per therm over that entire lifespan. We will also look at this in terms of over like a 10-year period when we start to make these comparisons. So when we're comparing a solar water heating system compared to something like an electric or natural gas one, we have to not just look at the initial cost, because we get this all the time. Why would I spend $8,000 to $10,000 on a solar water heating system when I can just buy a natural gas water heater for $1,500? And the big difference there is that there are some costs to operate. Solar water heating systems have no operating costs. And so you are buying a piece of equipment that then can collect you free energy instead of buying a cheaper piece of equipment, but you have to continue to pay for. I liken this to either buying your own washing machine or going to the laundromat every week. Sure, going to the laundromat doesn't require you to buy any equipment, and it's cheaper initially, but over time, all of those quarters start to add up, and they add up very quickly. And at a certain point, that washing machine will have paid itself back, even though you had a higher initial cost. We do that all the time, or I liken it also to going to an arcade or buying your own gaming system. The amount of games that kids play these days, that gaming system pays itself back quite quickly. I always bring up this advertisement from the 1920s day and night ad is that the sun, like salvation, is free, and so we have access to this free resource. So in other words, we can't just compare the upfront costs, but we have to look at these long-term costs. But remember, we can't ignore removal and decommissioning. It's a common thing that people also will overlook. So when we're doing this analysis, what we're trying to figure out is, well, in year one, how much will this save me? How much does it save me in the first year? But one of the things is that the savings will increase over time. So the cost of energy increases, and so my cost savings increase each year. And that depends on the rate of energy inflation. And this is something that's really tricky to pin down because now we're trying to project energy futures. And it's best to actually look historically as to where they are. And this is natural gas energy inflation rates over time. It doesn't include the last few years, which plummeted and then went back up again slightly. And what we saw is that in the 70s, things were very stable until the oil embargo, and then we had this huge spike. And then the oil embargo ended right about here, and then things stabilized. And then we have things like 9/11, and then it went down, and then it went up again. And now because of fracking, it's gone down. But now because of fracking, it's gone up because we've increased the markets that are out there. And so it's difficult to add some sort of a projection line to this when such dramatic things can happen, especially things that are happening rapidly. It used to be a lot more stable, but now who knows what's going to happen. I can look at what happened in the 2013-2014 winter in my area with propane prices. All throughout the Midwest, there was a huge propane shortage. I bought my propane to fill my tank at $1.25 in the summer, and my friend just down the road bought it in the wintertime, and he paid $3.75 just months afterwards. So you can have, all of these huge fluctuations depending on when it's purchased. So it's difficult to actually pin that down. What I like to use is about a 30-year average, and natural gas has about a 7 to 8% average annual increase. That means it costs 7% more this year than last year. Obviously, there's some years it goes down, but the general trend has been to see this 7 to 7.5 to 8% increase. Electricity is almost even harder to pin down because we've got such a dynamic electrical market. In some areas, we're starting to actually put a price or try to value the carbon that's on there. And if we really start to try to value carbon and put a tax or a price tag on the carbon that we're emitting, then this price will go up. Its 30-year average is in the 5 to 7% range, but it's certainly been increasing on the upper end of that in the 7 to 8% in most regions over the past few years. So that's the numbers that I like to use. Somewhere in those ranges, again, hard to pin down. However, what these don't account for is some of the additional costs associated with the consumption of fossil fuels. Like I said, we are not putting a value on carbon, nor have we ever valued what that is. And these are things that we call externalities, things that are external to the price that we're actually paying, that we pay, just not when we pay that particular bill. Someone else is likely going to be paying them. And so there's a lot of things that we externalize in the price that we pay at the pump. There are also concerns about increased government subsidies for things like fossil fuels that are driving their price down non-uniformly, and things like when we do have problems with climate change or emissions that are going into the air, does that increase the cost of healthcare or paying for rebuilding and infrastructure due to global climate change and increased severity of hurricanes and things like this? All of those things are going to have an associated price tag. There are some economists that have tried to estimate what this is. I would really encourage you to read Lester Brown's book called Plan B. I think it's on 3.0. They've now released the full text of that book as a free PDF online. So you can just Google Lester Brown Plan B and you'll get that full book. I always have some of my first year students read it. And they looked at the price of a gallon of gas. And you factor in removing government subsidies, environmental externalities, and the healthcare, and all these other things, that it probably should be more like about $14 to $16 per gallon. At those prices, then solar has absolutely no competition. So that's something that we do want to consider about what the true cost is in addition to some of these things like subsidies. And it's a common critique about renewables that they can't exist they wouldn't exist if we didn't such heavily subsidize them. But what we're seeing here is that between 2002 and 2008, traditional type fossil fuels receive far greater subsidies than we saw for renewable energy. So many of us in the industry say, sure, get rid of those incentives, but get rid of these incentives as well and create a more level playing field. So the problem with subsidizing traditional fossil fuels is that we're encouraging people to then consume more. If we were closer to the actual cost or an unsubsidized cost, we would realize how expensive they actually are. And this type of structure fails to incentivize people to be energy efficient or conservative or to consume renewable energy. Now, after all that, we still have to pay for them. And we still want to talk about this term of payback. And so let's address this. Now, the simple payback, you just look at that initial system cost and you divide it by the annual savings. So as an example, let's say the system costs $10,000 and it saves you $1,000 a year. In that first year it saved you $1,000, that would give you a 10-year payback. The problem with that is that it saves you $1,000 the first year, but the second year it will save you, 7% or 10% more than that. So it's actually going to be saving you $1,100. And then the following year, that $1,100 increased another 10%. And so you're saving like $1,210 or so on. That value continues to increase. So that's where we look at something like equity payback. We take into account that we will be saving more and more each year, while still accounting for the value of the dollar and net present value. So our incentives or our financial analysis tools like RETScreen or SAM do take into account that, yes, you could have put this money in some other place, or that you've got a loss of liquidity or a loss of equity. Here's one of the outputs that you will see from something like RETScreen. This is a $5,000 system that is comparing to, I think, like 12% or 12 cent a kilowatt hour electric water heater. And you see that it has a payback of about 9 years, which means that this is showing cumulative cash flows. The initial cost is negative $5,000, but over time it whittles away. And then after 9 years, the initial cost that you invested into it is equivalent to what your savings have been. And these are the inputs that I used for that particular project. However, when we look at something like payback, personally, I think it's kind of the wrong way to look at it. A lot of people disagree with the use of the term payback because we don't compare payback to anything else. We don't say, what's the payback on granite countertops? What's the payback on the deck that I put in, or the hot tub that I put in, or these other sort of improvements, or the paint on my walls? Does that have some sort of a payback? Sure, it increases your equity and maybe you'll be able to sell your home for more, but the same holds true for a solar water heating system. So why do we have a different burden or a different threshold for solar water heating systems? I actually like to switch this a little bit, and instead of thinking it in terms of payback, think of it in terms of prepayment. So let's say that system has a payback date of 10 years, just to simplify it. So in a 10-year period, the initial cost that you put into it will be equivalent to the savings that you have. So in other words, you will be spending that $5,000 on energy, whether you're paying for a solar water heating system or whether you're going to be just buying propane or buying gas or buying electricity. So I always tell people to imagine that you split into two. Okay, so there's you and then you have a twin. And you guys are going to live the exact same identical life, but you're going to make one different choice. One of you will choose to put up a solar water heating system, invest that $5,000 after incentives, put it up, and the other one will just continue to buy electricity to power their electric water heater. You take the exact same amount of showers, you consume the exact same amount of hot water, you have the exact same quality of life and lifestyle. And then 10 years from now, you look back and you both have spent the exact same amount on hot water. In other words, you will be paying for a solar water heating system whether you put one up or not. You're going to be spending $5,000 on energy. It's up to you as to where to put that money. However, there's a catch to this, and that is after that 10-year payback period, a couple things don't happen. One, nobody comes and brings you a giant check and some balloons and confetti and says, you've reached your payback point. Also, the system doesn't explode, thankfully. It continues to produce energy for its remaining life. So in other words, you're paying for 10 years worth of energy, but you're getting 30 years worth of energy. Going back to propane, I purchased my propane and filled my tank, which last year I used a total of 40 gallons. So hopefully this lasts me for a while. But I filled up my tank in the summertime. And if I fill it up in the summertime, they cut me a deal, right? They say, well, we're only gonna charge you $1.25 a gallon. If you come to us in the middle of December when it's negative 30 outside, well, you're gonna have to pay $3.75 when there's a shortage. So there's an incentive for me to buy all my propane ahead of time. Now I have to outlay that additional cash to fill up my tank and to pay for it all ahead of time, but there's great savings if I do that. I've got a loss of liquidity. That money's not in my bank. It's tied up in propane, and so that's obviously something that I have to deal with. But there's a great deal to do that. The solar salesman comes with a little bit different deal. So imagine the solar salesman comes to your door and says, okay, if you pay for the next 10 years worth of hot water today, you get the next 20 years for free. If the propane salesman came and did that, all of us would be getting our checkbooks and trying to give them our money before they left. You get 30 years worth of energy for the price of 10, and that's such an incredible deal. Of course, you don't have liquidity. You can't have that capital to spend it, but it's such a great deal, regardless of whether that payback period is 5 years or 10 years or 15 years. However, that's not how we normally pay for things. Like, that's great. That's a great deal, but that's an imaginary propane salesman. That's that's also talking about things like the actual cost of fossil fuels and all this stuff. But let's look at the way that we actually buy things. And if we need $5,000 or $10,000 to buy a solar water heating system, most of us don't have that lying around in our couch cushions or underneath the mattress. So what we need to do is we need to finance it. Any major purchases are typically going to be financed. And so as a result, we have to go to the bank and we have to take out a loan. And so we take out a loan and we amortize it over a period of time, which means that we end up with one more monthly bill. And that's a bad thing, right? Boo, one more monthly bill that we have to pay. And so that's an expenditure, an expenditure, right? However, the solar energy is actually an income. It's something that you're getting for free. You just have to go out and collect it. And as a result, we reduce a different bill. So I have a loan payment, one more bill, but I have reduced my utility bill. And so that's a reduction of that. And that's what we see in this example right here. Well, let's say I have a $5,000 system. I amortize it over 10 years at like 5% interest. If I do that, I end up paying $55.51 a month, one more monthly bill. But if I'm comparing that to the amount of money that I save on a monthly basis from my electric bill, that's almost $40. So the real difference isn't that I have to pay a whole nother $55, is that I have to pay $16 more than I previously was paying. However, that number stays fixed. Let's look at the second year. And in that particular case, again, I'm paying still $55 a month. That number hasn't gone up. but my electric savings has gone up. That's gone up by about 5% because of energy inflation rates. This number stays the same while this number continues to increase. And in actual a very short period of time, we are to what is a negligible difference, right? We're looking at, oh, it's an additional $8 a month, right? That's like a value meal these days, or like a month's worth of Netflix. It's almost something that no one's going to notice in terms of your cash flow. And in a very short period of time, you're actually cash flow positive. And so we look at this, that we're start making money in a very short period of time, even though that payback previously, just on the raw numbers, was about 9 years. This is especially true if you're taking out any sort of a long-term mortgage. New construction, building a new home, the standard mortgage there is somewhere between 15 to 30 years, with the most common being a 20 or 30-year type of mortgage. And in my particular case, I built a new house. And when building, we took out a 30-year mortgage. And that particular increase in monthly payment is actually less than my monthly savings. In other words, the very first day I put the system up, I started making money. So I was cash flow positive on the very first day. In other words, I'm getting paid to have solar on my house. The payback was instantaneous as long as it's amortized over a long enough period. And that generally holds true at any amortization of about 15 years and beyond. So you don't have to have a 30-year note to make that work. 20 years generally works, and in some cases, depending on what you're offsetting, 15 years would work as well. So if you are looking to refinance or to build new, solar is a no-brainer because you're cash flow positive right away. Start making money right away. And this is the most interesting case, because imaginary propane salesman and all that other stuff, that's not how we actually spend money. We're living kind of paycheck to paycheck, month to month. And if we have something that puts us cash flow positive right away, then it's something that we should certainly be doing. When we look at what that particular cash flow looks like, notice that there is a negligible difference the first couple years, but then it rapidly increases. And we really haven't talked about what the total numbers are at the end, right? We're looking at, if we can make this system last 40 years, this $5,000 investment will make us $60,000 over that period. So we know that they can be some pretty sound investments with really good return on investments. And those are the remaining numbers. So again, here's the, if you want to calculate and do your own numbers, I would encourage using RETScreen, and we have a tutorial that's right here. You can get us, but there's a bunch of other spreadsheets and online programs that are out there. RETScreen is what we use to produce these particular graphs, and you can see the same. Okay, well, that ends the webinar series. I hope that you've enjoyed yourself as much as I have. I look forward to answering any of your questions during our Q&A portions later on. Have a great day.